So, how can you invest in bond market? Apart from buying the actual bond, you may also invest in an index funds or ETF that track a broad, market-based bond index. The index tracks the performance of a basket of bonds, depending on what you would like to buy. For example, you can track U.S. Treasury bonds or high-ratings corporation bonds or even a mix of them. It is the easiest way for you to enter the bond market. However, you have to be aware of the commission fees charged for investing in bonds of mutuals funds and ETF. Remember to choose the lower fees one. For example, Vanguard is best known for issuing low commission fees ETF and index fund. What types of bond can you buy then? The most common one is the fixed rate bond. It simply means you would get fixed interest rate every year until the date of maturity. People usually buy it when they think the interest rate has already reached the top. Buyers would benefit from the drop of interest rate, while suffer from rising interest rate in the future. The contrast one is floating rate bond. It means that the interest rate would fluctuate every year, depending on the federal funds rate, or other benchmark. People buy it when they think the rates would rise in the future. The pros of buying such bond is that you would benefit from a rising interest rates. The cons is that you would get hurt from a declining interest rate. Also, it is harder for you to estimate future income. A more defensive choice is a Treasury inflation-protected securities. It offers a low coupon rate, which rises with inflation and drops with deflation. By doing so, you will be risk-free from deflation and inflation. However, the drawback is that the inflation adjustment is treated as taxable income. So you would pay more tax than buying Treasury bonds during inflation. Lastly, you should be aware if that bond is callable. A callable bond is that the issuer can redeem the bond before the stated maturity date. They would do it when the interest rate is low, which allows them to borrow at a more beneficial rate again. Although this type of bond offers a higher coupon rate, however, you will not get a stable income. Generally, corporation bonds are not recommended, as their interest rates are only slightly higher than that of Treasury bonds. Meanwhile, you won't have to worry about your bond being called in early, as well as the default risk for Treasury bonds. Also, you got more trading volume, meaning it is easier to sell Treasury bonds, plus you don't need commission fee to buy one. If you really believe in that company you are buying bonds with, you would have bought their stocks instead. I hope that you had get a better insight about investing in bond market. If you have any question, feel free to comment as below. We will share more about investing in stock markets in the upcoming videos.